Our guest expects economic uncertainty to continue in Canada this year, especially with those renegotiations of the North American Free Trade Pact and Washington politics unpredictable, to put it mildly. He does think that economic growth in Canada will be limited at only about 1.2% for the year. We're joined by Chris Murray, Managing Director of Institutional Research at ATB Capital Markets. Chris, great to see you. Thanks very much indeed for joining us. So it is a bit of a tough prospect for us this year. Maybe not a drop in economic output, but lots of headwinds.
Yeah, certainly, Andy. And we were thinking about, when we started thinking about our outlook for 2026, really it was what was underpinning our thoughts around what we were seeing is not only the level of economic growth, but also a lot of the uncertainty that we've been seeing. If you look back on 2025, when we got to April, we certainly saw that there were record levels of uncertainty both in Canada and the U.S. with a lot of the tariff implementation. That has come to pass. But again, in Canada, what we're going to see is the CUSMA agreement, the U.S., Canada, Mexico Free Trade Agreement, open July 1. And right now, that has really protected a lot of Canadian industry. So we think that, that on the macro front, we're probably into a lot of uncertainty. So I think that's what's really going to be interesting is it's going to be, a year where we think individual stock picking is going to maybe take over from, kind of broader economic growth or index growth.
The Canadian consumer, is that a big part of your calculation here? People famously always feel the economy is worse than it is. We don't have an economy that's in a recession right now, it appears.
Right, and what's been interesting, and you may have heard the term the K-shaped type consumer profile, and what we're seeing is that for folks at kind of the top end of the income structure, things are great. We're seeing lots of spending on what you can see luxury goods, autos, travel, things like that. But if you're on the lower end of the spectrum, what we're seeing is continued pressure on wages, concerns about employment and the quality of employment, and even some of the consumer spending. So, we've heard a lot of the commentary from some of the U.S. retailers that they're seeing, maybe consumers trading down in certain cases. But in other cases, and I'm sure we'll talk about travel, a very healthy, robust travel demand. And again, like luxury vehicles have been, a bit of a bright spot amongst a tighter automotive market.
Well, speaking of travel, Air Canada is one of the stocks that's favored at your shop right now. What's the upside for Air Canada?
So we'll start with the fact that we've got a $32 price target and outperform rating on the story. But we believe that Air Canada is set to benefit very strongly from that level of travel demand that we're seeing, particularly from boomers, but also by Canadians who are looking to both travel internationally and even across the country. We're continuing to see good levels of business travel, and that's being borne out by a lot of the demand picture that we're seeing. And we think that, this year will be interesting as Air Canada introduces new aircraft that'll open up some new opportunities for growth into some different destinations that they haven't been able to previously serve.
Atkins Ray-Elise, the big engineering construction company, mostly engineering, I guess. Where's the upside there?
So I guess there's really kind of three pieces of it to think about. The first of it is really the backdrop, and you think about construction, both in Canada and the U.S., and a lot of the discussions around wanting to build in Canada. They're going to be a beneficiary from that. They also have the ability to participate in some of the growth in the U.S. and certainly organic growth rates have been very healthy. In the high single digits, and that's been, above normal for the last few years. And we think that that's likely to continue. But I think the other thing to think about is that Atkins is now at a point where it's going to play catch up to the rest of the industry. Historically, M&A has been a big part of the story. We think that becomes a bigger part of the story this year. as well as the fact that their underlying business continues to improve, and we continue to see that being a real positive. The other thing that's really special about Atkins is their nuclear business. They have the CANDU technology, but also exposure to a lot of the other sectors or parts of the nuclear infrastructure outside of CANDU technology, be that small modular reactors or services. And they've got a footprint both in Ontario and Canada. They're working with a number of the firms in the US and throughout Europe and the UK. And we think that nuclear is going to be a big driver over the coming years.
We've only got a couple of moments left, but NFI Group, the bus maker, you see upside there?
We do, and so again, you talk about individual stocks and focusing on what's gone right or what can go right. So over the last few years, NFI has been dealing with a lot of the echoes of the pandemic, but we're now set up, we think, for a very strong recovery in earnings. Backlogs are at record levels. They've got a healthy funding backdrop for what they're going to produce. They have the ability to produce on both sides of the border, so they're generally insulated around tariffs. And we think we're going to see very, very strong earnings growth this year. And we think that leads to a re-rating in the shares as we go forward.
Chris, thank you very much indeed. Really appreciate it.
Yeah, thanks, Andrew.
Chris Murray, Managing Director of Institutional Research at ATB Capital Markets.